Have you ever felt handcuffed by trading rules that seem to limit your freedom in the stock market? What if I told you there's one rule that catches most new traders off guard? Stay tuned because not only am I going to explain this rule, but I'll also share two incredible tricks to dodge it effectively. Hello, everyone. I'm Margie, and welcome to Money, Stocks, and Trade. Whether you're a seasoned trader or just starting out, understanding the intricacies of trading rules can save you from a lot of headaches and losses. So, today we're diving deep into the infamous pattern day trader rule. And if you stick with me until the end, I've got two tricks up my sleeve that will help you maneuver around it like a pro. Now, before we get started, nothing I say today should be taken as financial advice. You should do your own due diligence and research. Never copy any traders, including myself. If you need assistance with the market, you should also seek out the help of a financial advisor. If you're in agreement with that, then let's keep going. Picture this, it's your first week of day trading. You're enthusiastic, your trading platform is set up, and you're ready to conquer the market. You make a few trades, some profit here, some losses there. Then suddenly, you're hit with a notification trading restriction imposed. What just happened? A pattern day trader or PDT rule is like the market's watchdog enforced by the SEC and FINRA. This rule applies to US stock traders using margin account. So if you make four or more day trades within 5 business days, and those trades represent more than 6% of your total trading activity in that period, then bam, you're labeled a pattern day trader. But here's where it gets sticky. Once you're tagged as a pattern day trader, you must maintain a minimum balance of $25,000 in your account. Drop below that and you're stuck. No day trading for you. So, how do you keep trading actively without getting snagged by the PDT rule? Let's find out. Let me tell you about Sam. Sam was a newcomer to trading, just like many of you. He started with high hopes, but didn't count on the PDT rule. And after a few enthusiastic trading days, he was barred from trading because his balance dipped. Sam felt like the rules were boxing him in, stifling his potential. It's a common tale, but here's where knowledge becomes power. Trick number one. Start with a cash account instead of a margin account. Cash accounts aren't subject to the PDT rule because you're using the cash you have without borrowing from the broker. It means only trading with the money you own, which inherently limits how many trades you can make based on your available funds. That's a handy trick, right? But what if you could still use a margin account and dodge the PDT restrictions? Stick around. I've got another trick for you. Here's the second trick. Utilize multiple brokers. That's right. Spread your trades across two or more brokerage accounts. By doing so, you dilute the number of trades attributed to any single account, keeping you under that radar of 4 trades per broker. You like that? So there you have it. Now, I always recommend good brokers. So, how do you find good brokers? If you want to hear that, leave me a note in the comment. So, there you have it, traders. Two clever ways to stay active in the market without getting tripped up by the PDT rule. If you found these tips helpful, why not give a thumbs up, subscribe, and hit that bell icon so you can be notified of my latest video. And remember, share your thoughts and experiences in the comments below. Have you ever been caught by the PDT rule? How did you handle it? Let me know. Thanks for watching. And remember, in trading as in life, it's not only about playing by the rules, it's also about smartly navigating them. Keep learning, keep trading, and I'll see you in the next video. Bye for now.